We're going to be discussing how Congress rips you off and how they hide it. How do they do that? Well, they do a sneaky tax increases. How do they do that? They do not adjust deductions, limits, and phase outs for inflation. And there are many of them. And what does that equal when they do it? A permanent annual tax increase that you really probably don't know anything about. Let's start with a few of the smaller ones that impact business. You think they're smaller till you look at how much they've changed the limits. Business gifts, for example. This was established in 1962, and it was done. It had a good reason because everybody was just giving all kinds of stuff away and, to customers and employees, basically calling them gifts. So that way they didn't have to pay taxes on them. It was basically you could deduct it, and it wasn't income to anybody else. So 1962, Congress decided to wrangle this thing in, creating some limits. And what the limit was at the time was $25 per person per year. This goes back to 1962, and it has not changed. Anything over $25 was not deductible unless you added it, unless it was included in the recipient's income. So, it's kind of a hassle, but it really limited those retirement gifts and also gifts to your favorite customers. What would the value of this be in today's dollars? $270 per person that business could give away, and that is the equivalent value of the 1962 $25 limit. So it involved, basically, you have a tax increase of $73.50 because you can no longer deduct those items. There's how we got the calculation for the tax increase. What about promotional swag limit? Doesn't seem like much, but it's related to the gifts. Basically, these are giveaways. When you go somewhere, or if you're a business owner, you give away a mug with your logo on it. You give away free pins. You give away cheesy items like your logo, maybe your picture, whatever, T-shirts. Did you know that those are limited to $4 per item? And that was established in 1986. Anything over $4 per item, and you need to track the recipients. You know why? Because it goes towards that $25 gift limit. What would that be in today's dollars? That would be $12 per item that you could give away as a freebie, promotion freebie for your business. Lost tax savings, $2.50 per item. Here's a bigger one that might hit closer to home, particularly if you own real estate. There's a real estate loss limit for actively participating landlords. What that means, if you don't know what an actively participating landlord is, that just basically means you make some of the decisions with regard to a rental. Doesn't mean to be much. Basically, you could just pay a bill a year, or pretty much. And you are an active participating landlord, and that means you can deduct up to $25,000 in rental losses per year if your income, this is a biggie, is lower than $100,000 per year. There's a phase out. Once you reach $150,000, you don't get any deduction at all. It carries forward. This was established with the 1986 Tax Reform Act. What would that be in today's dollars? $74,000 you could deduct annually in rental losses, and they would not carry forward. That is a tax increase of $14,700 per year simply because you cannot take those losses. What would the phase out be in today's dollars? You could deduct $74,000 if your income was lower than $296,000 per year. The phase out wouldn't end until $444,000. That means that owners, if you're a rental owner and you had a bad year, you earn under $296,000 per year, you could deduct up to $74,000 in rental losses per year, which would be an annual tax savings of $14,700 in tax savings. Then now you're paying in taxes. That equals a tax increase. What about the capital loss limit? As you may know, or maybe you don't, but if you're an investor or you lose money on an investment, you can only any gain you have is 100% deductible. But if you have a loss, you can only deduct up to $3,000 over your gains per year to reduce your taxable income. The remainder carries over to following years until you have some gains to offset it with. This was established in 1976. What would this be in today's dollars? This would be $17,500 you could deduct every year. And I've got a lot of clients, you have a bad year in the stock market, or maybe you lose, investment, you have a big loss. Some people carry over every year hundreds of thousands of dollars that they cannot take simply because of this $3,000 loss limit. This equates to an annual tax increase of $4,350. per year if you have those losses. Here's a biggie that affects everybody of retirement age. What about Social Security? Did you know Social Security was tax-free up until 1983 with the Social Security Act? That made 50% of it 50% of Social Security deductible. And then in 1993, the Omnibus Budget Reconciliation Act made 85% of that of your income taxable, Social Security income taxable. 85% is taxable if your income was over $32,000 if you're single, $44,000 if you're married filing jointly. What would that be in today's dollars? Get ready. $106,000 if you're single, $146,000 if you're married filing jointly. Let's look at an example here. That means Jim and Maddie, let's say they have $125,000 in modified and adjusted gross income, and they receive $44,000 in total Social Security. Because their income level under today's rules, because not adjusted for inflation, 85% of that is taxable. That's a tax increase of $11,220 per year that they now pay on their Social Security, which have been adjusted for inflation that they would not have to pay. That's called a tax increase every single year. Close out on a happy note. Overnight Edge. Hey, if you have any questions, if you have any ideas for an edge, please leave a comment. We'd love to hear from you. Check out our playlist for more tax and business tips. And if you really want to dive deep and learn something, check out our course offerings on Overnight Accountant.